Hello everyone, and welcome back to Wealthwise. It's great to have you here. In our last video, we touched on the basics of investing, and today we're diving deeper into one of the most popular investment vehicles, stocks. So, what exactly is a stock? Think of it like owning a tiny piece of a big company. A stock, also known as equity, represents partial ownership in a corporation, where each share signifies a unit of ownership and a claim on a portion of the company's assets and earnings. Now, why would anyone want to own these little pieces of companies? Well, there are two main reasons. First, you hope the company does well and the value of your shares goes up. This is called price appreciation. Second, some companies share their profits with their owners, the shareholders, in the form of payments called dividends. Stocks are bought and sold on stock exchanges, which are like giant marketplaces. You've probably heard of the big ones, like the New York Stock Exchange, or NYSE, and the NASDAQ in the US. But remember, almost every country has its own major stock exchanges. When you start looking at stocks, you'll see they generally fall into two main categories: common stock and preferred stock. These stocks are designated by different classes, example A, B, or C. These classifications are important because they determine things like ownership, voting rights, and dividend access. So, what makes a stock's price go up and down? It all comes down to supply and demand. If a lot of people want to buy a stock, the price goes up. If more people want to sell, the price goes down. This is influenced by how well the company is doing financially, the overall mood of the market, and broader economic conditions. Let's talk about how you actually make money. The first way is through capital gains. This is simple. You sell your stock for a higher price than you paid for it. The profit you make is your capital gain. The second way, as we mentioned, is through dividends. This is when the company gives you a cut of its profits, usually paid out at specific time interval. It's important to understand that while stocks have the potential for much higher returns than safer investments like bonds, they also come with greater risk because their prices can be volatile. So, how do you get started? Investors can use one of the brokerage or tax-advantaged accounts to invest in the stocks. A common approach is to invest consistently to take advantage of dollar cost averaging over a period of time, regardless of market ups and downs. That's our introduction to the world of stocks. It's a fascinating topic with a lot to learn, but hopefully this gives you a solid foundation. In our next video, we'll be exploring another key investment type, bonds. Thanks so much for watching. If you found this helpful, please hit that subscribe button to join our community and never miss an update. See you next time.